Hi, everyone. I'm James Garbutt.
And I'm Denny Dumas.
And this is the Garbutt Dumas Real Estate Podcast. All right. This is the Garbutt Dumas. Sorry, hold on. I got to take another stab. I don't usually do the introduction, so we're going to take another stab at that one.
This is definitely part of the podcast.
Okay. Yeah, leave it in, Carl. This is the Garbutt and Dumas Real Estate Podcast. And we're going to talk about has Vancouver real estate been a good investment? Is Vancouver real estate a good investment? We always talk about Vancouver real estate as a good investment, but we're not always thinking about it the same way. We're just looking at prices going up. So oftentimes, when you're looking at, from our perspective, we're all living here. We all have our money in Canadian funds, and in my research and just kind of a broad analysis over the last 10 years, a lot of typical properties in Vancouver have gone up 85%. So when you buy something for $1 million and it goes up to 1.85, if that's how it works over 10 years, you feel pretty good about it. It seems to be a good investment, right? Denny, is that a good investment?
Sounds pretty good to me.
Yeah, it says. Well, to me, I want to use this in a different way, and to me, the answer is it depends. It depends what you're comparing it to.
Right.
Okay, so just a real broad thing. And part of the reason why I'm talking about this is because I want to do a little segment in a blog post and a newsletter that we're sending out to clients about different ways to consider real estate as an investment. And it's hard to kind of talk about every scenario, if a property's cash flowing versus not cash flowing, if it's your home versus an sometimes real estate doesn't have to be investment. It's a home for a lot of people. Yeah. But the prices have performed well. And in my example, I looked at like a typical home. And the example I chose was 4657 Fair Lawn Drive in Burnaby, which is one specific home. One specific home.
Wow.
Because I wanted to translate it to this particular home went up 86.5% in 10 years, approximately. And that's in line with a lot of prop condos and detached in Port Moody. East Vancouver had some areas outperformed that. New West was slightly under that. But 85% over 10 years is a pretty common lift for a lot of property types in Greater Vancouver.
Yeah. Is there any reason that you chose that one specific home? Just out of curiosity.
I chose that one because it was one of the recent sales.
Okay.
It sold for $149 recently. And because it's in that Brent Lawn, Fair Lawn, Mid Lawn area, I felt that I wanted to look at what the value was 5 years ago and 10 years ago. And if I'm choosing one property, I need to know that there's going to be good comps in the same season 5 years ago, 10 years ago. And so there was always a comparable sale to give me an accurate value. Fair enough. Even though this one sold for $149 recently, like in the last 30 days, there's evidence that 12 months ago, it would have been around $144. There's evidence 5 years ago that it would have been around $124. There's evidence 10 years ago that it would have been $800,000. So I wanted to kind of put myself in the shoes of a buyer 10 years ago looking at this Fair Lawn house for $800,000, and if that would be a good investment based on what its value is today, that it just sold for $149. So a buyer bought this. Say a buyer bought, and this really, I'm using one example, but this translates to multiple homes.
Yeah.
So you buy a house in Burnaby for $800,000 10 years ago. Is that a good investment? It went up a lot, 85%. And from my findings, Denny, one, I want to really highlight this. It went up 85% in Canadian funds. Mm-hmm. Let's talk about international people. Back then, there was no foreign tax. So if you were using U.S. funds as your denomination, in 2010, there was moments where the Canadian dollar was above the US dollar. And in July of 2010, it was 97% of the US dollar. So it was almost at par. But in 2010, you could have bought this house, it would have been $800,000, say US funds. And today, the US dollar is more expensive than the Canadian dollar. So even though our real estate prices have, say, gone up 85% in 10 years, if you converted US funds 10 years ago and bought real estate, in U.S. funds, our real estate's gone up 42% in 10 years. And 42% on an investment in 10 years is a very modest, it would be a conservative investment. It's a low-performing investment. It's not like the S&P 500 by any means.
Yeah.
So I'm going to pull up So bear with me, guys, because I have chicken scratch notes all over the place here. So I'm going to be floating a bit. And I'm going to try to make this as like simple as possible, just because there's a lot of what ifs and there's a lot of things to consider here. So, but in short, $800,000 property, Burnaby, 10 years ago, today 1.49. So if you put down a down payment of 20% 10 years ago on that property, $160,000. Let's ignore property transfer tax, other stuff for a moment. Just keep it simple. So $160,000. If you invested that 20% down over that period of time, the value, the equity that you've gained from $800,000 to 1.49 is $690,000. Okay. Now that's not taking into account, interest on payments, property taxes, maintenance of the home. So there is some factors that you have to consider. But $160,000. If the gross profit of $690,000, that's the total lift in value. My estimate, and just rough and dirty numbers of interest over 10 years is $150,000 based on an $800,000 purchase price and taxes and maintenance of $100,000. So if you adjusted it for your sunk expenses, the net profit that I came up with on this house is $440,000. And this is hard to do without visuals, but try to hang with me here. So you put 20% down on an $800,000 property. You sell it for $149 10 years later, $690,000 lift. You have $250,000 of interest, maintenance, and tax expenses in that 10-year period. And you're left with a net lift of $440,000. If you put that same amount in S&P 500 10 years ago and reinvest the dividends, you would have a $400,000 lift. So in theory, you bought that Burnaby house with 20% down 10 years ago. You outperformed the S&P 500, which is very impressive in Canadian funds,
right?
Of course, right? Now here's where it goes different. Okay, so 20% down, $160,000. You're left with $440 after 10 years versus $400 in the S&P 500. If you put 50% down on the house, you're low risk. You don't want that risk. It's you want to reduce your payments. You would have made $1 million on the S&P 500, and instead of the $440 you would have gained in this house purchase. Okay, so this is over a 10-year period, and then if I were to kind of translate it over 5 years, if you bought this Fairlawn house 5 years ago. 5 years ago, we anticipated the expected value of this house was 1.24, and today it's 149. So 5 years ago, if you put 20% down, you'd be putting just under $250,000 down, $248,000. And your net profit after interest, taxes, and maintenance, I estimate would be $110,000. So the total gain from 1.24 to 1.49 is $250,000, but after your expense of living there for 5 years, you're left with $110,000. Now, if you invested that same $248,000 in the S&P 500, you would have $157,500. So if you bought this Fairlawn house 5 years ago at 20% down, it would have underperformed against the S&P 500. And if you put 50% down on that purchase 5 years ago, instead of if you put 50% down, you would have realized 110% profit on your purchase of Fairlawn.
$110,000.
$110,000 profit if you put 50% down. 50% down 5 years ago is $620,000. So if you put $620,000 5 years ago, you'd have $110,000 more 5 years later. If you put $620,000 in the S&P 500 5 years ago, you would have $393,700 more. So yes, real estate can be a good investment, but it depends on what you're comparing it to.
And it sounds like it's been proven to be a much better investment long term when you leverage it.
When you leverage it, you're using. I mean, here's a real simple thing. When you're leveraging it right now, you're using cheap interest, right? Yeah. So the more you leverage, if you anticipate the asset to go up 5% a year, and you're paying 2.5% on that, you're getting that extra lift, and it's not costing you any out-of-pocket money. So yeah, I mean, essentially, the more you leverage, the more risk you have in the short term, but it typically works out in the long run. Now, there could always be anomalies and exceptions, and you might have the worst year of sample if you did it today. But in theory, yeah, the moral of the story, Denny, is if you put less companies, publicly traded companies, outperform houses. And if you're going to bet on Vancouver real estate, put less down. Leverage more. But I think Vancouver real estate is a good complementary asset, and I don't think you put all your eggs in one basket. And if one asset's performing better than the other, it's just good to have different things going on. So anyway, that is comparing Vancouver real estate to the financial markets. And the thing about financial markets is it's liquidity and it's uncertainty, and there's, you might mistime it, and there's all these what ifs, but that's the same with Vancouver real estate.
Sure.
So there's going to be periods of time, and wild projections. If you bought a house in 2022 and it's 2 years from now and the prices are similar today, and you sold that house in 2026, I imagine that's going to be a high likelihood of a window where there's going to be a big run. Or if we went in the past and you bought a house in 2015 and sold in 2018, I think that would probably outperform a lot of financial markets. Yeah. But you don't know when that's going to happen. A couple other things I want to highlight just in terms of how to compare, like really look at Vancouver real estate. Some things I thought were interesting is gold. Okay, so this Fairlawn house, if you bought it in gold in 10 years ago, it would have cost you 640 ounces of gold. So your Fairlawn house was 640 ounces of gold 10 years ago. 5 years ago, it was 840 ounces of gold. And today it's 608 ounces of gold. So in theory, if you chose to buy the Fairlawn house as an investment or gold 10 years ago, what does that mean? 640 ounces of gold, you would have won on gold. Gold would have gone up more in value. And that's because 10 years ago, 640 ounces of gold would have got you Fairlawn. And today, 608 ounces of gold got you Fairlawn. Actually, that means, it's gone up in value. Yeah. The other thing, now this is getting a little ridiculous, but let's go with Bitcoin, okay?
Carl is a big fan of Bitcoin and crypto.
So if Bitcoin wasn't around 10 years ago, but I just thought, hey, you know what? Let's see how this place measures up in Bitcoin. 5 years ago, let's say fall, because it didn't exist in July, it opened in the fall. But 5 years ago, Fairlawn house would have been 2,838 Bitcoin. So 2,838 Bitcoin to get this Fairlawn house. Today it's 119. So if you bought 2,838 Bitcoin 5 years ago, you would have been outperforming your house by this Fairlawn house by 25 times. So that's a ridiculous thing. And anyone that bought that much Bitcoin 5 years ago is absolutely crushing it. And good to you. But in summary, I think Vancouver real estate is a great asset to hold when you're young, 20-something or 30-something, first-time buyer or in the earlier part of your life. If you leverage more on bank money as a true investment, it could perform quite well. Real estate doesn't have to be a true investment, though, and not everything does. But I will say, the more you leverage on real estate as a young individual, the better off you are. And later in life, don't pretend real estate's an investment if you're buying properties you hold. I mean, I have a lot of experience holding properties that do not cash flow for upside potential. And when I look back at the performance, it hasn't been that great. So buying to hold, if there's no cash flow there, over the long run, is going to likely lose. If it's a single family home, or if you're not processing the real estate, and by processing, I mean developing it, rezoning it, adding value to it, or if you have a cash flow, say up, down, rented home. If you're not processing the real estate and you're just sitting on it, over the long run, you're likely to lose over other options as an investment. That's it, Denny.
That was very informative. Thank you.
There's a lot of holes in this. There's a lot of what ifs. Try not to pick this apart too much. I can't explain all the scenarios. I hope you got some value out of this. That's all I have to say about Vancouver real estate as an investment. Thank you, Carl.
I enjoyed that.
Thank you.